Cool, let's hope. Cool, Mark, we introduced to Bronwyn, and that's all the body I'm going to use first up. Welcome. This is our first masterclass session on life insurance. Please come forward a little bit because it's quite a small room, so it'd be nice to be intimate rather than having to talk down to the back. Is there anybody here that's having trouble hearing me? Raise your hand. Okay, cool. Are you happy if I don't use a microphone? Great. Okay. We have an interesting session ahead of us looking forward in life insurance in the New Zealand market. And there's a clicker around here somewhere. Oh, here it is. Looking forward to 2030, a brave new world. And it is a session where we're going to be asking you to do some work and to do some thinking. So it's going to be lots of fun for us and hopefully lots of fun for you as well. To start with, I thought it would be interesting to have a little bit of a look back at the evolution of life insurance, because one of the things we're talking about here is the suitability of our life insurance products going forward. And doing a little bit of research, I discovered that ancient Rome actually had burial clubs where they'd pitch in money, and if someone died, they would use the money to pay for the funeral and for the living expenses of the survivors, which is kind of cool. But then it wasn't until the 16th century that we had a life insurance policy that was written in, well, policy is kind of a very polite term, I suppose, written in London, probably over a couple of pints, where there was a guy, Mr. Martin, who decided he wanted to write a policy on a life of a guy named William Gibbons, I think his name was. Is that right? And what happened is 13 merchants all gave this guy 30 quid, and if he died within a year, he paid them 400 quid. So it's kind of like gambling, I suppose. It felt a little bit like life insurance, but not so much. And then in 1706, we had the first life insurance company, as we kind of have today. Although the maths didn't really catch up, the actuarial of science, although Edmund Halley wrote statistical tables, a few years beforehand, the stats and maths didn't really catch up until the mid-18th century. DI insurance is a bit more interesting. That kind of arose initially with railway insurance, with companies in the late 19th century. I think it was 1883, the first company to do this would sell life insurance together with your rail ticket. So if the train crashed, you'd get some money for yourself to look after your injuries and expenses and so forth. Health insurance, also late 19th century. First social health insurance happened in Germany. Baron von Bismarck, I think, had a law that passed that created social health insurance in Germany. The private health insurance sort of arose a little bit after that, the early 20th century, late 19th. And as I'm sure many of you know, trauma insurance, as we know it today, was introduced by Dr. Marius Barnard in South Africa in 1983. Much later than the other products that I've talked about. It was initially covered 4 conditions, cancer, stroke, heart conditions, and bypass surgery. Which actually, Nick, who's one of our speakers today, was a friend of Dr. Barnard, who passed away unfortunately a few years ago. And Dr. Barnard said he wished he'd never included that surgery as one of the conditions, because you kind of had this really bad health event, you felt really terrible, and then you had surgery and you felt great, and you got money from the insurance company when you felt good. It was kind of bad timing, but anyway. What I would then ask is, have we had much evolution of life insurance products since then? We've got tweaking that's happening. One of our speakers today, Steve Wright, I used to work with when he was at Partners Life, where I am, and he's a product guru. And there was a lot of innovation happening in life insurance products around the place, but it seems to be tweaking of what already existed rather than any major foundational change. So we're going to start with a presentation from Shamubeel Eaqub. He's going to talk to us a little bit about New Zealand demography. Then Nick's going to come up and talk to us about insurance products around the world, because he's got a lot of global experience in that space. And then we'll have a panel come up and have a bit of a discussion about it. And as it says on the slide, if you've got any questions at any time, fire them into this. And then when we have the panel chat, I'll read that and start firing that stuff through. Come up the front, guys. The naughty seats are up the front. Plenty of room for you up here. So first up, I'll introduce Shamubeel Eaqub. Shamubeel should be familiar to most of you. He's a well-known economist in New Zealand, independent economist. He has in the past worked he was a principal economist at NZIER. Before that, he was at Goldman Sachs, JP Ware, had some time at Statistics New Zealand and at ANZ. What I really like about Shamubeel is he looks beyond the obvious. So rather than just looking at the numbers that are on the surface and telling us what's going on with the OCR and things like that, Shamubeel looks into the stuff that's a little bit less obvious and comes out with some really interesting stories. So Shamubeel, if I can invite you up first, please welcome Shamubeel to the stage.
Thank you, Mark. I was a little bit surprised to be invited to come and speak to you guys because you guys think about this stuff all the time. So what can I tell you that's going to be different? I think part of the challenge of the industry is that we need you. We don't want you. That's a very different thing, right? And I think the value proposition comes after the bad shit happens. So it's a really hard sell. So what you do is really, really important, but the way we tell the story and the way that people perceive you is actually a really difficult sell. And this is what I think we engage with all the time, and that's the reason why New Zealanders struggle, I think, with the rates of coverage that we have in New Zealand. When I think about the outlook for New Zealand, the reality is that the strategic outlook for your products and services is only going to increase because people are going to take on even more debts to buy shacks in Auckland. That's pretty much the technical term, right? You know, it's like you take $1 million mortgage in Auckland and you're getting a place that's leaking and falling down. We also know that people have responsibilities that stretch on much longer in their lives, right? We're living longer, we're living in debt longer, we're living with responsibilities longer. So the reality is that the overall, the quantum of need that's out there is likely to increase. But we also know at the same time the twin forces, the other bit that's coming at us quite sharply is affordability is getting really, really squeezed. Not just what's happened in the last couple of years, not just the inflation story, but a much wider story of fewer and fewer New Zealanders who are able to afford these nice things to have rather than just the things that we must. So I think there's a few things that we can talk about today, which I suspect we will uncover during the panel discussion and the workshop that we do afterwards. The reality is that even in risks, there are lots of opportunities. A little bit about thinking about what's our theory of change. If we want to change things in the life insurance market, how do we think it changes? Is it something that we do? Is it something that government does? Or is it something that happens somewhere in between? And finally, I think the thing that Mark talked about before is the responsiveness. Are we changing fast enough to the changing demand that's happening in society right now? And arguably, I'd say we're not, and that is the invitation, and that is the opportunity. I thought I'd start with a pie chart. I hate pie charts because they're stupid, right? But there was no other way I could do the little breakout. I don't know how to do the charts in any other way. But essentially wanted to show you, if you took an average New Zealander, this is where their money goes. This is the average New Zealander. If you took out all the different kinds of insurance, it would take up 14% of your income. And that's why the average New Zealander doesn't have all the different insurances. They can't afford it. Right? You can see so much of the money is going into things that they need. The only thing that I'd say is discretionary there is around 18% of the budget, and that's not enough, right? You still got to have some fun. You still got to drink some coffee and go to the cafe and stuff like that. And if you look on the right-hand side, the two bits at the top, the two most discretionary parts of insurance there, health insurance and life insurance. They're quite expensive, and they're seen as quite discretionary unless you must have it. You are a grudge purchase. And because people's money is being stretched further and further, it's getting harder and harder to justify. Show of hands, the number of people who bought fruit or vegetables last week. Your partner could have done it. That's okay. So let's say that's about 100%. So in the Household Economic Survey, on average, there's about 90% of households who bought fruit in 1987. In any given week, right? Not every week, in any given week. In 1997, it was similar. In 2007 to 2016, a bit lower. In 2023, it was 60% of households that bought fruit in a given week. 60%. If that number does not shock you, it should. That tells us that 40% of households did not buy fruit, or 30% of households did not buy vegetables in a given week. If you can't afford to buy fruit, vegetables, or meat to feed your family, can you afford to have insurance? Can you afford to have life insurance? What are the sacrifices that you're making? Our society is becoming very fragmented, right? This is where we are today. Not even where we're going. It's where we are today. Our market is getting squeezed in terms of people who can qualify to buy things. In the HES, again, it's not a perfect survey, but it gives you a bit of a sense of coverage by households. You can see that if it comes to the kinds of insurance that people buy, you have to get vehicle insurance because your car must have third party, right? So it's very widespread. But look at the other types of insurance. When it comes to life, it's only over 20% of households who have it. But it's a third of households who have mortgages. What are those other 10% of households doing who have mortgages and don't have life insurance? So there are some big things there that are happening in the market that worry me in terms of we are very much going to the people who must have it, not necessarily expanding our services to people who would also benefit from it. We know that one of the big drivers of buying life insurance and other kinds of trauma and other insurance is when you have big liabilities and big reasons why you must cover yourself. And the reality is that we're running out of those people in proportionate terms over time, right? Home insurance and the mortgage that goes with it quite often is the catalyst for getting that kind of cover. And home ownership rates in New Zealand had been increasing since the Second World War until 1991, has been falling since then, and is now at the lowest level since 1956. And it's going to keep falling because it's unaffordable. Like I said, I joke a bit, but it really is million-dollar shacks that we're buying in New Zealand. And so people are taking on enormous amounts of mortgages, but fewer proportion of New Zealanders are taking on those mortgages. So we need to be really, really mindful of where we're going to get those catalysts and the funnel of customers that are coming through. But we also know that people who are getting into mortgages are very lucrative customers if we can land them. If you had a customer who took on a mortgage in 1994, it would have taken them 13 years to pay it off. That's the average household. If the average household wants to pay off their mortgage today, it would take them 60 years. I mean, of course, the average household is not buying a house, right? Because it's the people who are in the top quartile who are buying houses. But it just gives you a sense of the duration of your customers is actually getting longer. The size of the market is shrinking, but the duration they're going to stay with you is probably longer. So the way we think about them, the way that we think about these customers has to shift in terms of the dynamics. And you guys are all smart people, you know this stuff better than I do. But I was quite shocked at just how big these changes are. That the need for your services have escalated so quickly because of what's happening in the wider economy. I also want you to think about the segmentation of markets, and I'm sure you guys do this all the time, but this is one way that I do it as an economist. And this is all the households in New Zealand. At the grey line at the top is the number of households that own their own homes. Roughly speaking, about a third of New Zealanders own their own homes without a mortgage. A third of them own their own home with a mortgage. And about 140,000 of people who have mortgages are extremely stressed. They're spending more than 40% of their household income on simply repaying their mortgage. So there is not a lot of fat, right? And then you look at the people who are renting, your prospective future buyers. Of all the renters that are out there in New Zealand, which is about a third of households, only about 200,000 are renting their home without any form of housing subsidy. Your addressable market is tiny. It is those 200,000 households that are renting without subsidies. They have sufficient income, they just haven't quite made it yet to buy a home. But all those other people are on some form of housing subsidy in New Zealand, and that group of people is getting bigger and bigger and bigger every day. And what that tells me is that potential market for you is shrinking and shrinking every day because people simply cannot afford the basics of their life. I also don't want you to think that the segmentation of markets like a ladder. Right? Sometimes we talk about housing and how we live like a continuum, and in a continuum you kind of think, you'll get better, and then you'll move from being renter to an owner, and then eventually you'll have no mortgage. But what we're seeing at the moment is actually people are getting stuck in remaining in those high needs parts of the housing continuum. So the way I describe it is there is no housing ladder. At the bottom end of the market, it's a game of snakes and ladders, and all the snakes are at the bottom. So just be really mindful of the segmentation of the market. That left-hand tail of society is getting bigger, the tail is getting fatter, and it's getting much less able to dig itself out of that situation. When I look at where the life insurance purchases take place, who our customers are, this is out of one of the FSC surveys that was done in 2019. And again, this will probably be true for all of your books as well. the coverage kind of by age group is very much in that kind of in the prime working age, right? So people age between their 30s and 50s to late 50s. That's where kind of our market really is. So I did a piece of work for Business New Zealand a few years ago looking at the demographics of New Zealand, and we were talking about labour markets. But I think the same thing applies to you guys. You're going to run out of your customers. The share of New Zealanders who are aged between 15 and 64 is at its peak. We're never going to have more people entering the workforce than leaving as we do today. So the share of New Zealanders who are aged between 15 and 64 is going to fall for the foreseeable future, regardless of how much immigration we have. And that means we need to keep getting people earlier in their life. We need to keep them longer through their life. And we need to extract value and give them more value through their working lives for longer, because the market is not going to grow naturally. The demographics are one thing you don't have to be an economist to figure out, right? I mean, we always get it wrong. But the reality is that there's one thing that we know: we all get older, right? And this is coming at us in a really big way. And I look at the chart on the right-hand side. I showed that chart to a lot of different people. I showed that to a bunch of dairy farmers down in Invercargill recently. And they go, surely that's not right. It's like, mate, it's been happening in your place a lot longer than every other part of New Zealand. You should know. You can see it in this room. They didn't appreciate that. Having said that, the reality is the absolute size of the market is still growing. So we should not assume that just because the composition of the population is changing, that the size of the market is not going to grow, that there are no opportunities. Of course there are. New Zealand is still, relatively speaking, quite prosperous. Relatively speaking, will be growing. There is a lot of uncertainty around it, but the projections are, of course, still quite positive. And we also know that people are living a lot longer. Somebody sent me a little book recommendation recently called The Longevity Imperative. I don't know if any of you read it. It's quite an interesting book. And essentially it goes, how are we going to help people live better lives? We're living a lot longer, but we're not necessarily living healthier. We're not necessarily making the most out of it. And the longer you live, the more risk you've got to be able to adjust to respond to. And the reality is that if we can sell it right, what you guys provide in life insurance and trauma and other things are actually part and parcel of making that long life that we're going to live better. Right? It's how do we live that longer life better? That's really what we have to sell. At the moment, we're selling the story of longevity as if it's a problem. You're going to live too long. You're going to be a burden on society. Well, are you really? Only if you don't prepare. And we have to give people the choice and the options to be able to have a conversation that's about that. I also wanted to tell you that we're quite often wrong. So I don't know if you guys know, I'm quite infamous in Wanganui. I called it a zombie town once. And they had a zombie march in my honor. I thought that was quite fascinating. I haven't been invited back since then, but, let's park it there for now. I had a child of Wanganui, but I updated this for Rotorua as well because I was really fascinated by Rotorua as a conversation, because it's one of those places that's changed really rapidly recently. But Wanganui did exactly the same thing. So right after I called it a zombie town, pretty much from that year on, the population there has been growing massively, just to spite me. But what I wanted to show you was the reason why I had called it a zombie town was because all the projections were there, things are going to get terrible. All the demographics were saying things are going to be terrible, right? But what happened was actually really different. So when you segment your market in terms of different parts of New Zealand, the reality is we're going to get it completely wrong sometimes. And you've got to be really flexible to be able to take advantage of opportunities when they come. And when you look at that period over the last 10 years, we've had massive population growth in our provinces, and extraordinary, and I mean extraordinary, right? It's gone from almost having no opportunities to being one of the fastest growing parts of New Zealand. And you can see on the right-hand side where that population growth has come from. Natural population growth, not so much, but massive amounts of inward migration from overseas, a lot of New Zealanders leaving. So this is one of the things that we need to grapple with, right? A lot of how we talk about things is about people who are already here. So, the segmentation of the market is so critical because so many people that we're selling our services to, they might pick up sticks and go to Australia or to the UK tomorrow. How are we going to make sure they remain our customers in the future or if they can port our services? But also, how do we deal with the customers who are coming in? These people who are coming in from all over the world, coming from very different backgrounds, very different markets, very different product availability. And they're coming into New Zealand with what we do here. And I can tell you as a customer of life insurance that it is bloody hard to buy life insurance. Right? It's complicated, it's not easily comparable, and my broker was very nice, but not that good. Right? So I had to work really bloody hard to get a sense of, like, what am I buying here? I see some people from the company that I buy my life insurance from. I won't name them right now. It's fine, right? I mean, I haven't died yet, so I don't know, but I'll find out. The thing I wanted to sort of get a sense of was, like, this is so unpredictable, right? This stuff is so unpredictable. There is, even in demographics, even what's going with the customer segmentation, they're changing all the time. And our customer needs are actually super dynamic, particularly in a country like New Zealand, where we actually have a lot of population growth compared to a lot of other places. It's coming from huge amounts of people leaving and a huge amount of people coming in. That churn should be an opportunity, but that opportunity will only come if we're responsive enough to be able to take advantage of it. And we know that the future of New Zealand does look very different. I think the people who are aged over 65, we should be selling them grandkids insurance, right? When I die, my grandkids are going to get a little payoff, right? We should be doing something, because the reality is that we know that with what's going on is hereditary sources of wealth is becoming an issue. But nobody's got enough houses, not nobody. Not many people have enough houses to give all the houses that they need for all their grandkids. So we're going to have to think about, how do we create products not just for parents, but also for grandparents, because we want to tap into that older 65 plus age group who are relatively healthy, they're relatively wealthy, and that's probably going to be the last generation that's going to be the case. So the next cohort of 65 plus that's coming in, they're more likely to enter retirement with mortgages or in renting. So they're going to be very different kinds of cohorts of older people that are coming through. And like I said before, also the mix of people who are coming into our market is changing quite rapidly in terms of our ethnic mix, our locational mix. New Zealand is going to look so different. And our products really have to keep pace with the different ways of living. So for example, when it comes to our Maori, Pacifica, and Asian households, we know that they're much more likely to live in extended families rather than nuclear families. So how do we create products that are able to morph to that changing nature of what households are like? And this is a picture that really surprised me. So I was chatting to Ian, I can't remember his last name. He's like a demographer from way back, and he was like, we've always known we're going to have more singles and couples in New Zealand. I was like, yes, that's true, right? Because we're getting older as a family, the children are leaving, the empty nesters and all that kind of stuff. But funnily enough, the fastest growing family group over the last 20 years has been families with adult children. Those bloody kids are not leaving. Or they're coming back, right? So this is the boomerang families, or they're coming back to save a deposit, or the sandwich families, right? The parents are too old and they're coming back, all that kind of stuff. So there's a whole bunch of things that are happening, but that adult children family, like literally the fastest growing household in New Zealand, that is really interesting, right? Do we have the right products for those kinds of family groups? And are we moving fast enough to take advantage of those family groups? So all I'm trying to explain to you is that even when it comes to demographics, it is such a changeable and dynamic space. There are so many economic pressures that are coming at us all at once that the way we live, where we live, how we live is changing all the time. It presents to us either a risk because our current products and services are not fit for purpose, or you can flip it over and go, that's where the growth is, that's where the opportunity is, that's where we create a point of differentiation. We also know that people are living very differently, and each generation is living their lives differently. On the left-hand side is the prevalence of diabetes, and you know that these numbers better than I do. But essentially, for most cohorts, if you're born in 1940s, you were pretty sick, right? Because we didn't have good nutrition and all that kind of stuff. But in successive generations, things got better until the generation that was born in 1983, and they're likely to be sicker than previous generations. So when I look at this stuff, what I see is that we've got these wider issues that are coming through the pipeline. On the right-hand side, you can see that we're just all really stressed out and really pissed off, right? The levels of anxiety, levels of depression in New Zealand in each generation has been escalating. So your customers are thinking with their red brain, right? You're much more likely to be selling into people who do not have the headspace to think rationally about complex decisions that are hard to buy. Are we really, really getting into understanding the psyche of these different cohorts? Because the reality is that we know that the entire purpose of what we're trying to do is give people value for money, right? We want to create products and services that's going to make their lives better. But is our choice architecture fit for purpose? Is the way that we have designed things, is the way that people are being funneled into making this decision, are they right? The reason I say use the words choice architecture, we use that in public policy all the time, right? It should be easy to make the right decision. Is it easy to make the right decision when it comes to buying your services? My personal experience is no. It is bloody hard work buying the right thing. It should be much easier. It should be more comparable. It should be more modular. It should be much more flexible. It should be easy to buy the thing that you want. It should be good value for money, and I should know that you've got my back. At the moment, that's not easy. And when I look at this picture on the right-hand side in particular, with more and more people feeling more anxious, feeling more depressed, having less headspace to deal with things, and also people getting into older ages in worse mental health, tells me that the risk profile of what we're dealing with in each cohort is changing. So we need to be really, really mindful that demographics are not only about what we know, but about the shifts that are taking place within New Zealand. Now, this is a picture that I wanted to show you because everything that I've said today has come from a perspective, and your perspective is different from my perspective. I did a piece of work with Tuhoi. Have any of you been out to Taniatua? Fabulous place, and probably some of the hardest cases you'll ever deal with. Wonderful, right? It was probably the most fun job I've ever done as a consultant. The task was, how do you visualize and explain economic development from tikanga perspective versus how the people in Wellington describe it? So on the left-hand side is a picture of economic success from Wellington, and on the right-hand side is a picture of economic success from Tuhoi's tikanga. The words don't matter so much, but all I wanted to show you was we're using exactly the same words when we're describing success, but what we mean are entirely different. And this really matters because as an insurance product, as a seller, are you selling to yourself, to your vision of success, or do you truly understand what your customers want, and are you selling it to their vision of success? Now, this might be a bit hot and heavy for this group, but I want you to think just a little bit creatively. The reason I took an illustrator with me is because I could not explain the differences of what I was meaning by success, what I was meaning by prosperity, what I was saying were the foundations and pillars of success were not the same things the people I was talking to meant when they used those words. The pictures of success are different, and there needs to be a lot of humility in understanding what different people want. And the reality is that it is going to be very different from people to people. So it's an invitation for us to have humility in trying to understand what do our customers truly want? Do we truly understand? Because the nature of our market is shifting very rapidly. Everything that we see from the data tells us that our customers are going to change. But do we know what their mindset is? So I'll circle back to where I started. The reality is that what you do is really, really important. If you think about it rationally, you create extraordinary amount of value for people. But need is not the same as want. Need is not the same as a voluntary purchase. The need is not as something that you enjoy buying. The story of value, I think, has to be told a lot better. I think it's an invitation for all of us to engage on this because the reality is that the value that you create is seen in very negative circumstances, right? When something bad happens, it's the entire purpose of what we do. But we have to tell stories that are better. When I think about the strategic outlook of New Zealand, I think generally speaking, I wear a black hat, like I'm quite a depressing kind of guy. But I want you to know that there is actually going to be more customers, but the shape of those customers are going to be very different. They're going to live in different places, they're going to look different, they're going to have different wants, and they're going to have different needs. And we want to move with that. It's going to be very dynamic. Affordability is a really, really big pressure. We need to figure out how do we access more people having pricing that fits. The average New Zealander cannot afford your products and services. You gotta get to the middle. We need to have choices that not only target the people in the top quartile, but also the people in the middle. Only then will it become mainstream, because it has to be the median New Zealander that can purchase and see value in the product that you provide. For me, there are plenty of opportunities because the need is not going away. But I think there has to be a conversation about the theory of change. How do we go from where we are today to where we go? And how do we become an industry that is super responsive to the incredible rate of change that's coming at us? Thank you.
That was incredibly sobering. I think the most accurate comment was the black hat right at the end, actually. Thank you. Some really cool themes coming out there, which was exactly what we were hoping to set the scene with. around the changing demographics within New Zealand, the changing buying patterns in New Zealand, the wealth changes, which affects the accessibility of insurance in this country, and also the migration-immigration patterns, where we've got a product that's very jurisdiction-based. Next, I'd like to invite Nick Kirwan up. And Nick is a very experienced life insurance person, but not just from the little lens of New Zealand. He's worked for the Association of British Insurers. In Australia, he's worked for MLC and another company I can't remember. It doesn't matter, says Nick. He was involved in putting together the moratorium on genetic testing in Australia. So has had some really serious conversations in this space. Has got a very interesting global lens. We know what the products are that we offer in this country around life insurance. It'd be really interesting to get a bit more of a global perspective about what's happening in other parts of the world that we don't know about. So Nick, welcome you to the stage, please.
Well, good afternoon, everybody. And firstly, just let me say it's an absolutely fantastic privilege to be here to speak to you all. And we prepared our presentations without conferring, but it looks as though we might have conferred, because I'd like to talk about a couple of examples in the UK in particular about how they do things differently, and one which speaks directly to this whole issue of affordability, and one which speaks directly to this issue of how do you extend into later life and extend the life of customers, and so two examples of how the UK has specifically addressed those two issues in ways that we haven't yet done in New Zealand. So I've worn this tie today because this is my travel tie. It's got a picture of a suitcase on it and a stack of shirts and some sneakers and stuff. So I'd like to invite you, with your permission, to come with me to take a look at the UK market, and we'll maybe see how they've done things just a little differently over there. So the things I really wanted to talk about mainly are a couple of product things, but it's worth mentioning that probably pretty much everything they do in the UK is different to the way we do it here. There are lots of process things which are different. For example, one thing I've not seen done here is if through underwriting they offer you cover with an exclusion in the UK, almost exclusively they'll give you a premium discount. But I've not seen that happen here. But if you imagine you've got an IP policy or TPD cover with a mental health exclusion or a back exclusion, you're actually getting a lot less cover. And for IFAs, it really sweetens the pill. It means it helps them not lose their commission on those sales. So IFAs absolutely love it. And things like that. But the things I wanted to talk about were sort of probably bigger things than that, because that's just a small process thing. But there are lots and lots of things we could discuss about how they do things differently over there. Now, the one thing about life insurance that we all have in common, and I'm going to start with this theme, is that life insurance does three things for mums and dads in the world. This is the same in the UK and Australia and here. The three basic needs that life insurance addresses for mums and dads. I'm not talking about business insurance here, just mums and dads type cover. And the three things are, firstly, it ensures you can maintain a reasonable standard of living if illness or injury stops you doing that. The second thing it does is it allows you to provide for your loved ones if you're either not there or not able to do that yourself. And the third thing it does is it allows you to prevent passing on debts to people who can't afford the repayments without you. They're not the products, they're the needs that life insurance enables you to meet. Now, the first need about having a reasonable standard of living, that's income protection, right? That's our product that meets that need. And that's pretty much the same here in Australia and the UK. So I'm not going to talk about that. But there's an important difference between New Zealand and the UK in those other two needs. Because in New Zealand, we have one product which has lots of different benefit types you can add to it, TPD and trauma and stuff like that. But it's essentially a lump sum product. But the UK has two. They do those two needs differently. So let's jump on a plane together and go and take a look at the UK market. Here's the makeup of their market last year. Thank you, Swiss Re, for the numbers. They do it every year for the UK market. And I'm really just going to focus on the top two lines because they're the important ones. So level term assurance, that's broadly equivalent to the product we have here. So the sum insured is level. And the premium is usually level guaranteed. It's a fixed term. That's a little different to here. But even though the sum assured is level, you can increase it with CPI, that sort of stuff every year. And so it's sort of very similar. It pays a lump sum on death and terminal illness. You can add critical illness and accelerated TPD. That's different in the UK, by the way, I should say. There's no standalone TPD in the UK. Did you know that? They don't have it. And TPD is one of the named critical illnesses in the trauma product. So it covers you for cancer, heart attack, stroke, and TPD. And there's a huge overlap in those two things, because quite a lot of strokes are going to lead to a TPD claim, cancer and heart attacks too. And that means TPD only accounts for 4% of trauma claims. So putting the two things together makes them much more affordable. And it also addresses a need, because one of the criticisms of trauma, as it is what if I get one of the illnesses that's not on the list? And in the UK, the way that's positioned is you say, but if you get anything else that's not on the list and it stops you working ever again, you still get the money. So it addresses that issue with trauma. So that's just a different way of thinking about it. But overall, that's the first product. That's the one we sell that's like here. And by the way, in 2023, they sold very nearly 1 million of them. This is a huge market in the UK. Obviously, the population is 70 million, so they sold 1 million of those. But it's the second line I really want to talk about, because this is what they do differently. So that first line, the top line, that's the one that says I want to provide for my dependents if I can't. The second line is the one I want to not pass on my debts to my loved ones who won't be able to afford the repayments without me. And we heard from our previous speaker that there's a lot of people who've got mortgages who can't afford this product. But the take-up of this product in the UK is incredibly high. And by the way, they have, household income pressures as well. If you look at this, it's a decreasing sum assured. The term matches the term of your mortgage, and the sum assured decreases over time as the mortgage debt is paid off. That makes it a lot cheaper. And it's a level premium product. But of course, that's easier for the actuaries to arrange, because the sum assured's going down as you're getting older. So it's a different product. The take-up of critical illness riders on that product is higher, and also the affordability is much more for people with mortgages. So what's the appeal? Well, essentially, the way it works is this. The other thing that's different in the UK is all the products are available joint life first event, first death. And that's perfect for a mortgage product, right? How many times do you need to pay off the debt? One debt, one payment does it. So joint life makes good sense. That's cheaper than 2 lives. And with this product, you've actually got first of almost 8 events. Because if it's life A dies, life A is terminally ill, life A is critically ill, life A gets TPD, pays out. If life B dies, first of 8 events, but you only need 1 payment to pay off 1 debt. So that makes it much, much more affordable as a product. It's half the price of covering it this way. Secondly, mortgage advisors love it. Why? Because it fits the conversation. Imagine this. You all know this. When you're buying a house and arranging a mortgage, it's one of the most stressful times of your life for people. It comes right up there with divorce and being made redundant. And so when people are doing this, that's just what they want to think about. They don't want to think about their KiwiSaver and other stuff. So the mortgage brokers there will say to the customer, look, I know it's a very stressful time for you. Let's just do the stuff we need to do to get you in your home, right? And then in 2 months' time, 3 months' time, when you're settled in, you know what your budget is, you know who you are, all the stress is behind you, let's have a broader conversation. But for now, are we agreed? Let's get you in. That's where your mind is. Customers go, yeah, please. That's what I want. Just get me done. And of course, because it's more affordable, you get a greater take-up of the product to the number of mortgages. And we heard there's a huge gap in New Zealand. And guess what? You get a greater take-up of the rider benefits as well, because the whole thing is literally half the price because of the design. And here's the thing. This would be great for existing customers, wouldn't it? So if you're an advisor and a customer rings you up and says, it's gone up by how much? Don't you realize how much pressure my budget is under at the moment? well, how about if the advisor was able to say, well, look, we can still offer you full protection. Why don't we just switch over some of your risk to this other product, which is much more affordable? We can save you a ton of money every month. And of course, because it's a reducing risk, you can do that without underwriting. Wouldn't that be good for customers whose budget is under pressure? And of course, this is a bit more affordability through design, not lack of profitability. This is just designing the product better to meet that need. So we can talk about that a little bit more if you want to during the panel debate. But I wanted to move on, keep it moving, and talk about the other end of the spectrum, about what happens when we all get older. And the UK has addressed this market in itself. I spent my last 2 years in the UK, by the way, working for the International Longevity Centre, which is an apolitical think tank based in the House of Lords that advises government on demographic change. And my role, I was Care Funding Advice Director, so this was something that was very close to my heart, of thinking about what happens when we need care in later life. And there's been two types of products in the UK. One which was a spectacular fail and crash, which I'm going to talk about first, because let the shipwrecks of others be your sea marks. And one which has been an absolutely spectacular success. And I'd like to talk about that too, and say what worked and what didn't. But first, let's talk about the shipwreck. Not spend too long on that. But essentially, this product was designed, and you can think of it as an income protection product, in a way. So you pay a premium every month, and instead of being a claim if you're too ill to work, it's a claim if you need care. And that's assessed on ADLs, whether you can wash yourself and dress yourself, those sorts of tests. And it pays an income from that point for the rest of your life, essentially, because when you go into a care home, there's usually only one way out. So the companies that launched these had reviewable premiums because they thought, oh, we haven't got much data here, so why don't we have reviewable premiums? And therefore, if this goes wrong, we can put the premiums up. But that raised the question amongst buyers, is this really insurance? Because the chances of needing care is 1 in 4 in the UK, 1 in 4. That means you've got a 1 in 4 chance of making a massive claim, and a 3 in 4 chance of losing all your premiums today. That's quite a big call. It's not like a life insurance call. And that led to huge amounts of anti-selection in this product. And the underwriting they used wasn't up to it. What they were doing is they were using traditional life insurance underwriting techniques. So the question was, have any of your blood relatives suffered any of these nasty diseases before 65? Wrong question. The question they should have been asking is, have any of your blood relatives ever had dementia or Alzheimer's? Because that's what people were selecting against, because that hugely increases the duration of the claims and hence the cost of the claims. And they know their family history, and we weren't asking it properly. So the cost of care was a lot more than they thought because the portfolio was skewed to dementia and Alzheimer's, and we weren't picking it up on the anti-selection. And then what they found was it was worse than that, because when people with Alzheimer's dementia were getting 3 hot meals a day and a nice warm room and not wandering about and getting lost, they were living a lot longer as well. So the cost of claims went up, not just because they were skewed, but because the people were living in better conditions, living longer because of it. So guess what they thought? Let's increase the premiums, we're going to have to. And that led to a massive amount of complaints amongst the consumers. And that meant the regulator stepped in with fairness regulations. And they said, right, show us your books. Remember, they've had fairness regulations a lot longer over there. Show us your books. And what the regulator found was, so you did the financial modelling of the impact of this on your business, but you didn't do any modelling of the financial impact on the customers. You can't write to customers who are all retired on a fixed income and say, give us an extra £200 a month or your cover's cancelled. So the regulator made them reverse out all the premium increases, and these products don't exist anymore. Shipwreck. But there's a product that's been an absolutely fantastic success. So I'd like to talk about that as well. Really close to my heart, this product. It's called an immediate needs annuity. And what is it? It's a product you take out which pays for your care costs for life, but you make the decision at the time you need the care. At the time you need the care. So the question for the customers is now an entirely different one. It's not, do I need care? You do. You're at that point. You actually need it now. The question is now just, how do I best pay for it? That changes all the dynamics of this product. And it's underwritten, but of course it's the opposite of life insurance underwriting, because the worse you are, the better deal you get, because you're going to be in care for a shorter time. So for a while, the market had to encourage advisors to say, look, come on, you need to get all this stuff down on your application form. Tell us, you know, if you're a smoker, tell us, you know, if you do all that stuff, tell us. But the great thing about this product is what the IT people used to call WYSIWYG. What you see is what you get, because it's simple. You pay us this much and we pay these care fees. That's it. There's no more. And because it does exactly what it says on the tin, there's more or less no complaints. So why is the market so successful for this product? Well, let's look at each party to the contract. First off, there's the person who needs the care. Who are they? Well, the first thing about them is it's 1 in 4 of us. We don't know who they are, but they self-identify now because they're coming to us at the point where they actually need the care. Their average age is 85 at the time they need the care, and almost exclusively they're a widow or a widower. Why is that? Because when 2 people live together, the first one that needs care is looked after by the other one. It's the one that's left on their own after the first death that has to go into a residential care home. So they're almost always a widow or widower, almost always. They bought their home, by the way, 50 years ago. So they're homeowners almost exclusively, and they're living in their own home at that point, and they're going to go into care for an average of 2 years. But be careful, because averages are hugely deceptive here. The variation is really wide. It could be anything from a few months. If the person's got Alzheimer's or dementia, it can be up to 10 years. So it's that variation that creates the uncertainty for customers, and the fact that you can do it for a one-off fixed price at the outset that creates the uncertainty, that removes the uncertainty about it. So then there's their children. Who are they? Well, they're a generation younger, so they're 30 years younger than 85, so they're in their mid-50s, these people. And they're going to be the decision makers. They're the ones that decide. They're the ones that are saying, Mum, Dad, it's time. We can't look after you anymore like this. We've got to give you some professional help. We've got to sort that out. And so they're playing an absolutely key role in this. And then you've got the financial advisors. I should point out at this point that they've set up a thing called SOLA accreditation in the UK, which is hugely important. That stands for Society of Later Life Advisors, and their president is Lord David Lipsey in the House of Lords, who's a fantastic advocate for this product and the whole system. And then you've got the last people, the residential care homes. So let's just think about what each of these parties gets out of this transaction to understand the success of it. The person needing care, it's obvious. They get their care fees paid for life. They've got no more financial worries. What we're actually looking to do is fund the gap, because they'll have some pensions, some things which are fixed. They'll need a bit of spending money for buying presents for the grandkids, that kind of stuff. But essentially, they're looking to fund the gap from the care fees, between those pensions and what the care fees cost. So they get certainty and remove all financial risk out of this. They're never going to run out of money. What about the children? Well, they get the same benefit, really, because they get the benefit that they know Mum and Dad is going to be looked after for life, no matter what. But they get one other really important benefit. What's that? They get to accelerate their inheritance. Because with the care fees paid for life, they're going to sell that home and inherit the money earlier, on average 3 years-ish earlier. So have you heard of the term inheritance impatience? Well, they get something very important out of it. What does the advisor get out of it? Well, the advisor gets a hugely expanded market because most referrals are referred down to the children. But now you've got a new market, which is referral up, because at the age these people are, they've probably got a financial advisor, but now they've got a product that they can refer to their parents as well. So it hugely expands their market into a new product. And by the way, the advisor is going to help them with that early inheritance as well, and help them decide what am I going to do with that. So the advisors get a lot out of it. And what do the care homes get out of it? The care homes get out of it the fact that they know they've got a customer whose care fees are paid for life. They're never going to have to face the issue of potentially rehoming somebody, which is very painful, all of that. And what we found in the UK is that the care homes agree to link their fees to the CPI of the immediate need annuity, so that both parties agree that's what we're going to increase the fees by, so there's no shocks for absolutely anyone. And that means it creates the virtuous circle, because it's usually the care homes that are the first port of call. When mum or dad needs care, the kids go around to all the local care homes and they say, what does it cost? What's this facilities like here? How does it? That's the first port of call. And what do the care homes do? They say, have you got a solar accredited advisor? Because they can really help you here. So they become the source of lead generation for the advisors in this process. So you create that virtuous circle of this fantastic product, which has no complaints, no regulator problems at all. And it's something that works really, really well in the UK. So I hope that was food for thought. We can talk about that a little bit more on the panel debate if you'd like to. But 2 examples of way other markets have extended their markets and improved affordability for customers. Thank you all very much.
Start with an opening question. I'm just going to start at this end, Mark, and then move along. And I'll ask just for quick questions at the moment. Shamubeel stepped up first and talked about the changing demographics in New Zealand. What do you think are the biggest risks to product suitability from the material that Shamubeel raised, or in fact anything else?
Okay, thanks, Mark. I guess as I look across the product landscape in New Zealand and compare it to what I've seen in other markets around the world, I would say that the New Zealand product suite, just for, I guess, the main protection products, is the most customisable that I've seen in any market. And so what that means is that if customers are getting the right advice, they will get suitable products. But the challenge, the other side of that is that if they're not getting the perfect advice, they might equally end up with an unsuitable product. And I guess with the changing market dynamics as well, advisors need to keep pace with how their customers are changing. And as well, insurers need to understand how they're still going to be giving good advice to those customers who may no longer be wanting to go to see a financial advisor. They might want to find out how to get insurance coverage in different ways. So,
Cool. Yeah. Thanks, Billy. Bronwyn, what would you like to add?
Look, I think it's difficult to have a conversation about product suitability without also thinking about access. And when we think about particularly Shamubeel showing some of the demographic change, and I'll touch firstly on migration, how some of these migrant communities are thinking about life insurance when they arrive on our shores, and the typical ways they would engage in their home country may not be the ways that they engage here in New Zealand. You know, in New Zealand, life insurance is predominantly sold through intermediaries. Those intermediaries have a particular look, and when we think about the changing look and shape of a community, might we see too great a social distance between the way access happens through life insurance products and what our migrant communities are thinking about. So I think there's something that warrants much closer scrutiny there, particularly as this is upon us now. It's not something that is, 20, 30 years down the way. I think probably the other thing is, again, this relates to sort of access to market and this overlap with product and linking the two. With life insurance, we tend to try and go against the grain of human nature, and I'm referring to the fact that we promote life insurance as a standalone product, when actually human nature, we're seeing more and more across New Zealanders' engagement with financial services products, particularly KiwiSaver and health insurance, being a much more natural way to engage with personal finance. So rather than thinking about individual promotion of life insurance, how might we start to sidecar or see some of those, some of their products sit more neatly alongside some of those more commonly, more easily accessed types of financial services?
Great, thank you, Bronwyn. If anybody has any trouble hearing at any point, please raise your hand and we'll start using microphones. So let's keep that in mind. Steve.
Yeah, so I think there are lots of issues, obviously, and we'll talk about some of them as we go along. But for me, the thing that has to change, I think primarily is the way we sell insurance. Right? We've been reasonably good at selling. I think that has to change. I think we have to change and to become advisors, and that means a mindset change. I think it means a bunch of things that we have to do better and do differently. And it doesn't help us, for example, that in some cases we put the cart before the horse, right? Because just helping some people with scope of service kind of stuff at the moment. And it kind of follows the disclosure rules for insurance, which say, what products are you talking about? Now, the product should be the thing that comes at the end of the process, really. It should rather be, what are the risks that you're trying to protect yourself against? The product should be a different thing altogether. I mean, and that should flow from what you're trying to help the client do. And I think, again, that's means a switch in focus for how we do things.
Right, thank you, Steve. Nick, anything to add from?
Well, I've already spoken about this, and I also couldn't agree with one of the and that's why in my presentation I said there are three basic things that life insurance does, both addressing your income and looking after your needs and not being relaxed, taking part of it. And so that's something I feel very passionate about. We should talk to customers in the language that they use. We do make things very complicated. The products are so complicated, they're almost impenetrable. And I don't know, but I imagine that if you interview customers coming out to the office and said, what did you think? They would go, what she said. or something like that. Because it's, and whenever I see a survey, customers say, the product designs are impenetrable. The complexities are huge, and it's the language you use and language you have in the way you describe stuff. Steve, we need to get back to talking about customer needs. You don't want to leave those debts to your kids. They can't afford the repayments without work. Let's get back to that and do that.
And no jargon. Don't use jargon in front of the clients that don't understand. Make it. Yeah.
I remember being in a seminar in the UK, and one of the investment advisors was saying to the audience, have you met that boy?
I personally don't understand why we sell, trauma insurance and disability income. These are meaningless terms for consumers. We should be selling a lump sum payment if something happens to you, or a replacement for your income if you can't work. Use the consumer freedom label. Shamubeel?
Look, my talk was kind of based on my personal experience of buying life insurance. As a life insurance customer, I can tell you what I handle that. Even as a person who's quite intelligent in these things, I find it very difficult to navigate. I find it very difficult to compare. And I find it a essential experience. I order things I must, and not because I enjoy the experience. And I'm not saying there should be a walk-in product to buy life insurance, but
Job number one, everyone. That's your job. We'll come back to that. Thanks, Shamubeel. Bronwyn, question for you. We've heard about the changing demographics in New Zealand. How do insurance providers and clients deal with this demographic change now? And we haven't mentioned things like splitting families and blended families and diaspora and all those sorts of things. How do we deal with those problems with our existing life insurance products?
Look, in all honesty, I think we're finding it very challenging. There's a lot of talk, less follow through, action-wise, because it is difficult, and anyone in the room here who works for one of the life companies will appreciate the daily conversations around legacy technology and passbacks and all of those deeply challenging aspects that distract you from doing forward-looking, positive, impactful things for new types of customers. Do you know, I think one of the first things we could do is we use this phrase channel all the time, and that is a completely industry concept. When New Zealanders are thinking about how they're going to buy life insurance, they're not thinking about channels in the way that we do. They're just simply thinking about access. And by the time there is that catalyst, as Shamubeel talked about, and the catalyst for us are changing. By the time they get there, they've probably had around half a dozen different touch points, right? They've probably seen a billboard, they might have seen a banner ad on their banking app, they might have had a conversation at a barbecue, they've probably seen some kind of blog application somewhere else. So there's been a series of build-ups until they get to that point where they go, I'm ready to buy. And then when they're ready to buy, they're confronted with these silos channels as we present them. Always intermediated, right? Because one thing I think we all know to be true is that life insurance is we need it. We need you, but we don't want you. And so the imperative of a nudge in the form of an intermediary, I don't think there's been anything better to replace that. So to answer the question, we need to start thinking more about what are those intermediaries, those channels looking like, such that they can be more effective at creating access and intuiting that need when it arises. And something we've been thinking about a lot is the changing face of advice. So at the moment, as I mentioned before, the face of advice looks of a particular age, a particular cultural ethnicity. There is some great work happening across the industry to diversify, bring in different gender, different ages, different people from different backgrounds, which is important if we're going to close down the social distance. But I think the other one that other industries are looking at and harnessing is behavioural science. So when we think about social norms, social norms are things just like rules that we live by, right? So giving up your seat for an older person on public transport in South Africa, buying life insurance is a social norm. It is not a social norm here in New Zealand. So how might we change some of the behavioural barriers, and that will take far longer conversation than this one, to start to normalise the accessing of life insurance advice by some of these different communities. There's just a couple of things, I think. But the other thing I'd say is there will be, with the emergence of things like open data, a greater ability for life insurance and other FS providers to more closely ensure that need when it arises. At the moment, we are totally dependent on someone coming to us or to an advisor, but how we more effectively use data to see that need the moment it crystallises could be potentially quite game-changing.
Absolutely. Yeah, thank you. Mark, talking diaspora, we are in a world where Kiwis, I'm sure, I know it's the same in Australia, we're hit our 20s and it's compulsory to go overseas for a couple of years, right? And spread your wings. Who did that? Who did their OE? Of course. Who got stuck and took a long time to come home? Yeah, a few of you, get a Longhand dictionary or something over in Europe, and then eventually you might manage to bring that person back. Some get stuck. Who's got friends that are stuck in the UK or some part of Europe and have never made it home? That sort of stuff's very common. We get migrants coming here from Asia. We've got migrants from the UK, from WIMAC. And insurance is a product that the later you buy it, the harder things are. So what are some of the risks of being a customer buying insurance anywhere in the world, or particularly in New Zealand, at these older age groups, and how do we address that?
Yeah, well, I guess moving countries has got to be also one of those high stress life scenarios, like renovating a house or getting a mortgage, etc. And insurance is probably not right up there with the things that people are thinking about. But speaking in general terms, I guess there's a few different scenarios. Maybe that person had insurance where they were before, and they went through the whole underwriting process. They either spoke to their financial advisor or broker or whatnot, got the right cover, and now they can't move it to their new country for a variety of reasons. So maybe hold that back, and then they need to go through that whole process again. That's not a great customer experience. And by the way, it's going to be much harder to get all those medical histories, the financial information that underwriters need to do it all over again. So that's a pain point. And I guess as well, like as people get older, there might be health issues that pop up that make it more difficult to get that insurance or more expensive. I think insurers do a pretty good job of eventually getting people cover. it's not going to be a fun experience for the customer and for the advisor as well. So I don't know, there's no easy answer on how to improve that, but yeah, it's definitely something that makes it more stressful for that owner.
And a health condition may have arisen in the meantime, right? So something that may have been covered for a home may be excluded from the country. Yeah.
Like the other thing for this is these people have fewer networks in this country.
Yeah.
And they actually need to cover more than other people because they don't have the social networks to pick up the slack, right? So the reality is these people have a greater degree of a need, probably there's more pressure on affordability, but more often than not, people come to this country with great hopes for their families.
Yeah.
So the mindset is actually really, really positive. You've got to get into it. So the psychology is very different from what you're seeing here. Psychology is entirely different from a person who's already here with a familiar community.
And if they're coming from an Asian country, they might be used to just going to the insurance company and wanting to buy a product, but you can't do that. In New Zealand, you refer to a financial advisor. It's like, what's that?
Absolutely, yeah. Thank you. Thanks, Shamubeel. Steve, how much major product innovation have we had in New Zealand life insurance the last couple of decades? It's happening.
So, well, there has been. I mean, there's been tweaking, really, I think is what Nick said, and that's probably true. There's been a lot of tweaking. You just have to look at the number of different trauma products there are, how their conditions have been improved over time. You just have to look at income protection, how that's improved. And actually therein lies the problem, right? Because they've become overly generous in many instances and so too expensive. So, I mean, nobody, well, let's think about it. Who really needs 100,000 paid for a minimally invasive angioplasty on a Friday afternoon and they can go back to work the next Monday? Right? That's really expensive, paying those kinds of benefits, right? I mean, advisors work their salt will know that if they combine mortgage repayment insurance and income protection for a client who has a disability because of an accident, which once you add in ACC, clients can receive much more than they were earning before they were disabled. And so that's irrational for those clients to get better and go back to work. That's a problem. Right? So I think we need some changes there. We need changes really, I think, that I wouldn't say get rid of those products because people may appreciate the generosity and are happy to pay the premium. But I think we need to develop more now the other way, right? And start finding, let's call them no-frills policies that are way less expensive, that do the core job of protecting the client reasonably well. The other thing I'd like to see, I mean, we've had one new product that I can think of, which is a standalone terminal illness product. And I think that's a little bit different in New Zealand because I'm not aware anybody else has that. I was involved in developing that a while ago, to find anything worldwide. And why that's important to me is because I think terminal illness risk, the risk of a financial event caused by terminal illness, is the risk separate from death. And when I'm talking to advisors, talking about this, I'll often ask them, so what are the 5 most important financial aspects you take into account when determining a life cover sum insured for a mum or a dad? And they'll say paying off the mortgage, paying off other debts, paying ongoing expenses, educating the kids, and maybe having a holiday or some other discretionary amount. Not one of them ever says, I'm putting in an extra amount of cash in here for a terminal illness cost. Right? So what happens is we have this life cover that's designed to look after people once the breadwinner of the life assured is gone. It all gets chewed up because of their terminal illness. It's not doing its job. So terminal illness cover, which doesn't pay when you die, pays nothing. It's a much cheaper way, a much more efficient way of catering for that risk. I think we can do the same with trauma insurance, right? Trauma risk isn't really one risk, right? It can go from being a risk that you have a trauma with no financial impact at all to having a trauma that can have 7-figure impacts. Now, using comprehensive and expensive trauma, generous trauma, to cover those very big risks is very inefficient. So I think we need more development in products that are more targeted towards some of these things. The other thing, if I might just continue for a minute, the other thing that worries me a lot is inflation and the eroding effects of inflation on money, right, and people's benefits. And we're really good at indexing sums insured, monthly benefits payable most of the time, but we don't index health insurance. Right, and to me that's really important because all health insurance products have annual claim limits. If these things don't get increased, and I've never seen a policy that has contractual indexation on them, if we don't increase those limits, what's medical inflation running at? About 10%, I think, for the last couple of decades. At that rate, the value of your benefit limit drops every 7 years or something. Right, so now if we're not increasing those limits, very soon a bunch of policies are not going to be fit for purpose for people. That's not good for their outcomes, that's not good for fairness, and it's got the potential to bring our industry into disrepute. So what I'd like to see from health insurance companies is start thinking about contractually indexing your products.
I hope you're taking notes, because when you do some work shortly, there were some gems in there that you might want to use as a starting point. Thank you, Steve. Moving on to accessibility, although you did bridge us a little bit there, Steve. Thinking about the distribution cost, about a third of life insurance premium essentially is distribution cost, right? It's a grudge purchase. Advisors have to work really hard to get people to buy it. And if you think about it, more than the first 2 years of premium is used to pay for distribution. So it's not until the third year of receiving premium that insurance companies are actually getting money to pay claims or getting money to pay their own operating costs. What impact does this have on affordability of life insurance? As someone who looks at a reinsurer, what do you see?
Well, look, I think all products have distribution costs, right? You go to Countdown or Woolworths, you buy a pumpkin, the price you pay is going to be a lot more than the cost of growing it. So there's a lot of costs in between. So getting product to market has costs. But yeah, in simple terms, if distribution costs are higher and all else equal, the price will have to be higher. But there's also the risk of underinvesting in distribution. If you underinvest in distribution, then your sales will be lower, your expense unit costs will be higher. So there's a balance, right? New Zealand probably has higher upfront commissions than most other markets in the world, I would say. But yeah, it also means that there's an industry of scale. So there's a balance that needs to be determined there. I think companies should think about where they invest in their distribution. Is it only in advisor commissions? Are there other channels, or there might be a better word, to also be invested in? But yeah, I think at the end of the day, if companies are able to reduce their costs in whatever way, it will lead to lower premiums because the market here is so fiercely competitive.
Yeah, absolutely. And we have the issue that Steve raised before, essentially about having an arms race and product quality, where everyone's trying to sell better and better products, which of course again pushes the prices up. That's a real challenge there. Yeah, please.
Because actually, if you think about it, critical illness is going in the wrong direction for sort of some of the reasons that Steve said. And if you think about health systems generally, in every developed country, health systems really would try and do three things. If you think about that. So the first thing they try and do is prevent events, accidents, all sorts of ways. Like stop smoking, speed limits, wear a seatbelt, eat healthier, fruit and veg every day, do regular exercise. All these things that are meant to improve safety and prevent injuries have scams. Then they want to try and diagnose it early, so we catch things sooner. That's going through your mammogram and also different sort of screening programs that we try to do to catch them as early as they can. And then the third thing is to do is they try and treat it better. Less invasive surgery, drugs, more effective targeted stuff to treat that. And all of that means that what's going to happen is the illnesses and injuries are going to happen less overall. And you're going to find them sooner when they have less impact on your life. And they're going to treat them better, which means they have an impact for less duration. So that trend is one that's going to be. And yet, you'd think that would mean the trauma definition should get harsher and harsher and harsher to be the same to make people's needs. But no, they're actually going the other way. I can tell you that in the UK, I was one of the first, in fact, I was the first author of the standard trauma definitions in the UK, which they've had for quite a long time, but moved away from them quite quickly. And I can tell you, every single time we did a review, the definitions of those standard trauma conditions got harsher in projects to stay in line with customer living prices.
Right, thank you. Chair, I'll stick with you if I can, although I will pull you back to the point around commissions, because we're having recently come from Australia, where Australia has now got upfront commissions capped at 60% and trails capped at 20%. Advisor numbers as a result, well, potentially as a result, have dropped dramatically as a result of all the regulation and the various attempts they had at trying to get it right to quite low numbers now. We now have commissions in excess of 200%. We've had Claire Bollingford say to CEOs in the life insurance industry that 200% is too high. We also have opportunities for efficiency that are coming in now that, we're all investing a lot in online application forms. We've got things like large language models that have a lot of opportunity to increase the efficiency of advice businesses. But essentially, the efficiency gains will accrue to the financial advice provider, not to the insurer, and will therefore have trouble reducing premiums when we have these efficiencies that are happening now. We can't really get the industry together and say, hey, let's talk about this, because the Commerce Act would stop us from doing so. Do you see commission changing in New Zealand? And if so, how? There was, yeah?
Yeah, look, I think first thing,
Hospital class.
commissions are at least as high in the UK. So the average commission to a dealer group in the UK would be about 240%. That's kind of what they would expect there. One thing is that's different there is that the standard would be a 4-year clawback period, and it's a straight line over 4 years. And the other thing that's different is that the trail commission is rather lower. And I think that reflects the fact that the premiums there, everything is sort of set at the outset, so it's a fixed premium, a fixed sum insured, like that decreasing term insurance product. It has a schedule that says this is the sum insured payable in each of the next 25 years. And that means they don't, for example, send out yearly statements. There's less work for the advisors to do in that, because if you did send out a statement, it would be the same as it was last year. It's still the same. Still the same. So that means their ongoing costs in terms of those things are a bit lower. Australia, of course, I worked there for quite a long time, about 7 or 8 years, and yeah, capping of commissions there is just a bit of a sorry story, really. The paper that was written, the Trowbridge report, wasn't actually written by John Trowbridge at all. It was actually written by a guy in Treasury who, what he knew about life insurance and advice could be written on a postage stamp with one short. And as a result, he thought this was going to be a good idea. And of course, capping commissions at 60% meant that the remuneration wasn't enough to compensate advisors for finding customers and providing, really important, is the element of encouragement to take place. So people really underestimate that effect of what advisors do, in my view. It's the fact that, that advisor has got that customer, potential customer, sitting in front of them, and they can say, look, should we just do this now while I'm here? Should we just get this done? And that's a really important nudge for the customer, because if I go, you probably won't do it. The forms will sit in the back of the thing. You're living around to it. Let's just get it done. And that's probably the most important conversation on the journey to being a life insurance owner. Customers don't like to do this on their own. It's hard. Unlike general insurance, they don't do it every year. They usually only do it sort of once every 10 or 15 years. So they're not familiar with the process in the way that they are with their car and house insurance. So I think we underestimate advisors at our peril. And we need to make sure that commissions are at a suitable level to appropriately recompense them for the massive amounts of work they do finding those customers, talking to those customers, and persuading them to enter the market. I would say one thing, so if I'm hogging Mike, or not Mike, there's been some talk in the UK a little bit about whether we should have differential commissions. Because if you think about it, the effort involved in finding a new customer to the industry and bringing them in for the very first time is immense, because if you're an advisor, you've got to advertise, you've got to find those customers, then you've got to bring them in, then you've got to get them through underwriting, and some of them are going to fail, and then you lose them, on the way, and all of that. And so by the time you get that person on the books, it's cost that advice business a lot of money to get them to that point. It really has. But then there's a different conversation which goes on, which is, look, it's been 4 or 5 years since I gave you that first advice. Would you like me to see if the time is right that I could get you a better deal, get you a bit more cover for the same premium? That conversation is like falling off a log. But yet we pay them the same for doing it. And it seems to me that there's scope to say, if you're bringing a customer into the industry for the first time, that's creating more value for the industry than if you're just moving a customer from A to B. I know there's pros and cons to that, but
I'm actually going to move us on to the next phase if I can. I've got a couple more questions lined up here, but I want you guys to do some work and I want to break. And I also want to read some of these fantastic questions that are coming in. So thank you very much for sending those in. You've got flip charts and a couple of markers on your table there, and I'm sure that the discussion that's happened so far has got you thinking. So what I'd like you to do is have about 10 minutes discussing in your tables things that we can do to improve accessibility of life insurance products in New Zealand and the suitability of life insurance products in New Zealand, whether it be something completely different from anything we've ever seen before. And I'm sure we'll be able to find some chocolate fish for somebody that comes up with the next Marius Barnard fantastic idea that changes the world, even though chocolate fish are no longer in production. So take 10 minutes, talk to the people in your table. We're going to come around and join you in that conversation. So any of you that have asked questions, grab us as we walk around and ask you questions while I read them. So please get started as a team. Please have a conversation. Join me. Got to be listening. Okay, what have we got down here? Thank you.
thank you.
Yeah, we started with the word demystify right in the middle, and then we realised that probably would have been a word that was here about 10 years ago. So we widened our net as we went thinking a few different things. Similar to the first table, we had a thought around group being such a shortcut to broaden reach. I thought that first table was a really good idea. We started then talking about as a nation, who are mostly self-employed. 97% of the country are self-employed. Is there a product design? Is there something that kind of mandatory kind of employs all the people that work for them? Is it a kind of a wider kind of group scheme in that sense, and kind of reaching out into the community? We then talked about kind of using technology a little bit more, and I think picking up some of the panel discussion today around kind of cultural norms, or breaking through the inertia that we all have. It'll never happen to me. Death will never happen to me. I can't envisage myself getting sick. Probably the same things that happen with, the reasons why we struggle to save for pensions and things, that we can't visualize what it will be like in 30 years' time. So we talked about this idea of, using kind of technology, using VR, using a way to kind of create quite a personalized experience for consumers to kind of just, extrapolate themselves, push themselves forward into a scenario that makes them feel a little bit uncomfortable, makes them feel about what does loss feel like, what does illness kind of feel like, to kind of just create a little bit of a nudge behaviour to that need.
Lovely, thank you. The idea about using VR, that you just had me thinking about it. If everyone's heard of tools like Be Human, or I can't remember the other tool where you record yourself at 2 minutes of video, and then you give it a written script, and it produces a video of you saying that written script, where you can age that person and have a conversation with your future self. How cool would that be? Just scaring myself.
Very similar kind of ideas from our table. It's kind of already been talked about. So we spoke about education, so which is a big thing, making sure that I guess it's understood the importance of planning for your future. Obviously, positive press as well. So if we can get a bit more, good stories around the industry out there, however that's done, also be quite good. But another thing that we kind of spoke about was just simplifying a whole bunch of stuff from an industry point of view. I think Mark, you mentioned it when you're up there, that all the providers have products that do similar things, but there's critical illness and trauma cover, and so even just maybe aligning the terminology of the types of cover can do a little bit to simplify the process. So and when it came to product suitability, we're just talking about kind of like having relevant products for particular, I guess, types of clients in their different stages and things like that. So kind of a bit of a crossover between the two.
Thanks, Nick. Okay.
Thank you, Mark. So our group actually were a little bit pessimistic about the ability for product innovation to sort of change this problem anytime soon. So we thought what was really important, similar to others, was to really focusing on financial literacy and doing a better job as an industry on trying to map advisors and the offering to the increasingly diverse range of customers that we have today, where it's pretty binary at the moment. Anything else, guys? We had a lot of amazing ideas. I think we'll leave on that high, I think.
Thanks, Nick. Good call with drinks coming up. Who we got from this table?
We're a bit like the back table over there, and we were the naughty table that spent a lot of time just talking, and so we've just hurriedly written down some stuff. So we quite liked the premium discount for health exclusions. We actually have some on a couple of our products, but we don't go as broad as some of the ones that were mentioned. But we sort of thought a lot more broadly we talk a lot about the customer, and we find a lot of the time actually there's a lot of stuff around regulation that sometimes hamstrings you a little bit around doing what is best necessarily for the customer. The regulation is viewed as being what's best, but actually if you talk to the individual customer, what is actually best for them. And so it's about, we talk about when advisors are doing their information out to the customer showing what products they're recommending, it's often gone, well, where's your rating house? Have you recommended the best product for the market? And it's all about what's actually best for the customer. Isn't it much better for the customer that they've got a cheaper product, which is actually quite a lot lower rated, but it's actually within their price point and covers them for the key aspects. And so just a little bit expanding on that, looking very much about sustainability measures as part of those product ratings. It's all very well and good that somebody's got a heart attack definition that pays at the top of the market and a cancer definition, but what is that actually going to do to your premiums long term? Is that going to remain sustainable for that customer?
Thank you. I'm very intrigued to hear what we hear from this table.
I think we're the naughtiest table, but really I think we spent most of the time discussing the panellists' ideas and views. So thank you all so much. It was very, very interesting and gave us lots of conversation. I guess the one point we finished up on was the accessibility at the end, and having the benefit of an Australian at our table was just the idea of being able to access KiwiSaver or superannuation as they do to pay premiums, which would certainly help all our customers get to the products more easily. So thanks.
Thank you. Okay, we've got a few minutes between us and a drink, so I'm sorry that I won't get through all of these amazing questions, but I'd just like to just go through the panel and ask you all to pull out maybe something that you heard that was interesting, and what did you find most engaging and why? In fact, I'm going to start at the other end, Shamubeel, and start with you.
All right, I'll start with what I didn't like, which was the focus on financial literacy. Stop blaming your customers. Yeah. The reason why they don't understand is you're not selling what they need. Speak to their need, don't try to educate your customers. You're missing the trick if that is your solution. What I really liked as an idea was the life stages idea that you guys had in a few tables. Yes, absolutely, products should grow and flex as people's needs change. But on the proviso, you've met the basics that people need. We're so busy trying to focus on the fancy stuff, we actually haven't got the basics right yet. Let's start there and have those options for people who can afford it. Rich people, fine. Sell them all the fancy stuff you want.
But I think the biggest innovation we need in New Zealand is cheap, basic products that meet middle New Zealand's need. We're missing a bit.
Completely agree. Thanks, Shamubeel.
And DTA's like that because the cover changes as you need. I thought the best idea I heard from the floor was the idea about continuation options in that corner. And I think that there's a lot to be said for defaulting people to continue the cover they have, because I suspect that people don't pay attention to this stuff and they may not even notice it's gone until they need it. And then what happened to my health insurance? What happened to my life cover? What happened to that? So I think that's a great idea. And I think also, just to add to that point, New Zealand's group insurance market is very underdeveloped compared to Australia and the UK. And I think one of the reasons might be, and this is where the FSC can help, you need to get rid of employee benefits tax on group life insurance benefits. The UK has 11 million people covered by group life insurance paid for by their employer in the UK, and they pay no benefits tax, no income tax on that whatsoever, because the government recognises it's a social good. So unlike health insurance, where everybody has free access to the National Health Service, so they do pay employee benefits tax on health insurance, but not in life, not income protection, not for them.
So if we've all got one message for Nicola Willis tomorrow, if anyone gets to sideline with Nicola Willis, that may be the thing to bring out. Fringe benefit tax on life and health insurance products really should go so that we can get more access to group schemes. Yeah, thank you. Steve.
So somebody mentioned about, the arms race and having to sell the best product. I think one of the things we need from the FMA and from disputes resolution services quite urgently is some guidance for advisors around what is expected of them, right? Because at the moment, many of the advisors I talk to seem to believe that their job is to maximize a client's ability to make a claim. And they have to sell the best product, otherwise they're going to be in trouble. I think that's wrong. I don't think it's maximizing the claim outcome. I think what the real thing should be is giving your client enough money when they really need it. That should be the first thing that gets done. And I think the FMA has to come out with some kind of guidance to say, as long as this is suitable for your client, does the job reasonably well, as long as you've explained it to them, as long as they kind of understand it, then, you're not going to be penalized for selling the top rating product, because that may not even be appropriate for the client, right? It doesn't generally take their circumstances into account. The other thing that I think from an accessibility point of view, it's not just about accessibility for new clients, although that's really important, but what do we do about making sure we keep our policies relevant for clients as they age, right? Because there are things we can do now by introducing some policies that cover the basics really well at a lower expense. I mentioned terminal illness cover early on. I think that's really valuable for people who are retired, right? Because once you've retired, hopefully you've saved up something. You're not just retiring on government super, which sadly many do. But what are you doing to protect your retirement nest egg, right? If one of you dies, it's not the end of the world. It's sad, but the other one's just got more money to spend. The real risk in retirement for me is a terminal illness that's not covered by health insurance, for example, or because the client's given up their health insurance because it's too expensive. And if you have a product like that you can convert some existing life cover to, when people get to their 60s, when life cover is starting to get really expensive, there's a better chance you're going to hang on to them for another 10 or 15 years, and they probably need that cover, many of them. So I think we need to think more about those kinds of things from a product provider point of view.
Great, thank you, Steve. Bronwyn.
Keep this short and sweet.
You're thirsty.
You can be the most financially literate person, and insurers can manufacture incredible products. What we are dealing with is not a build it and they will come product. And so, of course, being a distribution leader, I'm always going to favour the responses from the tables that focused on access and channel, and the two that I heard most likely to move the dial was this table here with systemic access through KiwiSaver, and I absolutely loved the compulsory continuation option concept.
Great, thank you. Cool. As long as we don't obfuscate the fees of insurance by embedding it in superannuation the way they do in Australia, it's nice to have the transparency that we have. No.
I was really going along with what Steve was saying around simpler, cheaper products, but as well as that, I really like package insurance with cool stuff. Normalising the purchase a bit more, normalising the advice process with things that people can relate to better.
Great. Okay, thank you very much, Mark. I think we're really close to time. I'd love to be able to continue this on for half an hour, but who's thirsty? Oh, only two. Great. Carry on. We've got some questions here. I'd like to really thank Shamubeel, Eaqub, Kirwan, Steve Wright, Bronwyn, Kirwan, and Mark McClenahan. Thank you very much for your time.